Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, September 12th, 2024. It is 3:09 p.m. Eastern Time as I'm starting the video, so we have a little less than an hour to go in the trading day. Figure I'd get one more out to you. And what I'm going to do is briefly cover the levels. I've already gotten these charts out to you in static format, screenshots. I'll go over these, a couple others, and give you the levels to watch, my thoughts, what to watch for next week. But what I also want to do is just take a look at a few of the economic indicators, some of the charts with the macro picture. So to recap, this is the primary downtrend off the highs. This is and has been since back here. We went long here right off this recovery of that support level, and that was a sole target. Thought we might get one last hurrah there, one little pullback or little jig, zag, and we didn't, but that's all the better. That's the final target. All along since here, I have not waffled. All the arrows went up to this line and then stopped. That's the reversal point. So, like I said, hard entry for me. Returning back to swing short positions in my trading account, and I'm very, very willing to give it at least a run up to that level. We'll see. Charts are dynamic. And also we have the Fed meeting next Wednesday. The meeting's Tuesday and Wednesday, and then they do the announcement. They're going to announce the rate cut on Wednesday. We know we're going to get one. Market just wondering if it's going to be 25 or 50. Probably be a quarter is my guess, but we'll see. I didn't even look at the Fed fund futures. Doesn't matter because whatever's there is priced into the market. And meaning the Fed fund futures, well, they have a probability chart. I'll show you what the market's betting on. And so the bottom line, the takeaway is, guys, there's always, leading up to a Fed meeting, noise in the market, whipsaws in both directions, both to the downside, false breaks of support, as well as the upside. So I tend to kind of widen up stops, kind of sit tight, and try to avoid getting shaken out on any whipsaws. So this is the first, and it's a big. That's why I have a color-coded yellow resistance level on the futures about 19,687. We'll call that 19,690. And then this level is also big as well. That's about 20,000 right there on NQ. That's also the level, if you recall back here. Remember, we were short off the highs, swing trading, covered hit. We hit a lot of targets, including my 6 target pre-market right there the morning of the 5th. That was also a hard reversal from out of close all shorts, go long for a bounce, expected to be potentially double digits and explosive, and that's what it was. And then scaled back in. It was a scale in, and that's the last time we hit that trend line there. And where I'm going is, I told you too that would be, I said if we went much above this level, that's that same level, that's where my stop out was on those shares that I scaled into then, so it was never hit. That's a level that if we take out much above this 20,000th level, then we're probably going to take out the previous highs. And of course, anybody would be a fool to rule that out. Anything's possible at any time in the market. All I can do is talk probabilities, give you levels to watch, which will likely determine that if broken. And again, so first off, it would be ideal, not absolutely necessary, but ideal for the bearish case to have this rally, this divergent low here capped. And what it would also do, remember the signature, I'm seeing more and more evidence day by day here, there, financials one day recently, but little things like this, we start to get divergences and positive, aka bullish divergence, bullish setups. And instead of playing out for the move to the next highs and beyond, especially because look, guys, we're not that far off the highs. The previous highs right now, we're down from the highs about 7%. So in no way, shape, or form, all your long-term trend indicators, even on the daily chart, intermediate trend indicators like the 200-day moving averages were above. So all I'm trying to say is you can't just, we're not at that point yet where you can throw away the key on short positions and sit back and wait for that, 40-something% drop to my deepest targets off the highs. However, those odds go up substantially if and when we pretty much now, since we've already tested this key support level, and we take out the recent lows, like I told you, yeah, that's a key pivot low, but I expect we'll probably, if we can take this out, we'll start to waterfall. And that is my preferred scenario. That's what I think will happen. But right now, let's see how they treat this trend line. If they pop it, You've got this, and then if they pop it, do they back test? All that's going to be bullish. These are what you want to see if you are long, looking for new highs. And it's what you don't want to see if short. You don't want to see a breakout above there. But again, we're not talking much. We're talking in percentage point, maybe a percent or so to that 687-ish, 688, and then a little bit more to that 20,000. All right, so let me show you QQQ, and then I want to get to some other charts. So this I updated today. I updated QQQ. As I told you at the time, QQQ is still a little shy of its downtrend line. These are the arrows that I've had for the last week drawing us to go here, up to this level, to this primary. That's the same primary downtrend line off the highs. We just have more reaction points on NQ. And like I said, close enough. I'm not going to sit here and try to milk out, even though NQ is my preferred trading proxy. So by that definition, I should be out with that, and adding to shorts there, which I did most certainly. And this right here is about, I think that's 0.5%. It's so minuscule, it's not even worth trying to milk. Now, again, if they pop that level, and then you have the price resistance just above. I have a color-coded yellow. It's pretty important, 477.72. And then this, again, is a level where that's the level right there where if we take it out, there's a big old gap right there. Yeah, but once you start taking this out, the odds really start increasing with every tick higher that the market might want to punch through and make new highs. What we have right now is exactly what I predicted back here the day of the lows on August 5th when we, posted, we hit that T6 on the futures, we hit T2 on the, various price targets and NVIDIA price targets, just about everything hitting 200-day moving averages and or price targets or trend lines that I had. And I said the narrative, you're going to hear a shift in what you're going to hear the media start to, in the market, cheer about the fact that this drop here solidified rate cut. It just sealed the deal. And that would be the catalyst for the rally, which we got. And we're still there. We're still above that high. And so the market's still giddy right now in the hopes of that, not the hopes, but the fact the Fed's going to cut. And I'm going to speak on that in just 1 second. However, I think most of that's probably, again, based on the technicals, it's probably run its course. So at the end of the day, guys, technicals rule the roost. You have my levels. You have where it starts to, increase the odds we're going to run at the highs. So nothing's changed in my outlook there. And again, I just wanted to reiterate, I think this is, it was and is where I figured this bounce would go to, and then we'll go down here. And so that's it. And then we hit, the S&P 500, especially when you look on the daily chart. And this is a 60-minute chart. There's the daily. Let's see how we close today. I'm betting this candle is going to come down. We're in that range right now. I'm talking about this range. I was hyper-focused on that when we were there. Said the break of that range will most likely determine the next tradable trend. We got that trend. We milked it. We turned around and milked it up. And now we'll probably, like I said, point out this morning we were there. We're a little bit above it now. But on the flip side, we have the NASDAQ at. And to me, the NASDAQ is the more important of the two. It might not be more important to the rest of the world, to CNBC, but because of the concentration of the market leaders in there, coupled with the fact, remember, we just had some sell signals on XLF. I'm not talking about that much now. I'll hit on it before I forget. But believe me, this weighs very heavy into my analysis that XLF, we had the sell signal that we were waiting for here. We went down, hit my first target, we bounced. We went down, hit my second target, we bounced. As expected, that's why you have multiple targets, and I gave you a bounce target range that would range from this downtrend line to back to T1. We're a hair above T1 now, so basically the next time we run down at T2, we'll increase the odds just like it did here. We had one little last hurrah off it after the first reaction, the initial reaction. That's all I really look for, and then the door is open to go down to T3. So bottom line, I think I have an alert. And if you want to just keep it simple, set an alert. You don't even have to watch it again. And set alert here. It's going to be bullish. It doesn't mean new highs. You can maybe sometimes a different trend line will form. You go up here, you pop it, you turn around there, and then maybe you have a new trend line. You still have a previous reaction high. And that will start to change things too. If you take out that reaction high, that's actually a resistance level. I'm just going to pencil it in here with this line. I'm not going to add it to my chart, but remember, traders always look at these reaction highs, and then you have another one there, and then it was support here as I bring the line across, and a reaction high right here where I'm ending the line. So resistance, pop, test, 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 fail, breakdown, back test from below, back test from below. So this is, heck, you know what? Do this too. If you want to just kind of keep things simple and not watch 100 charts, 1,000 charts a day like I do, set alerts on these. And that says, hey, look, guess what? Now, even if they take that out, it doesn't change until you start taking out the previous high. Maybe you want to go in for a back test of this trend line. I don't want to see that, nor do I want to ride it out short if it does. Why? Because we'd have to go all the way up here. We'd have to rally at least 7% or so just to back test. It's a steep trend line, and we're well below it. So at this point, I don't mind a back test early on. At this point, I'm not going to ride that out. So that's where, for those of you in the trade, you want to know where a good stop is for XLF, right above there. Let the market makers stay out of their range. Maybe give it on a daily or a 60-minute or 120-minute candlestick close, a little bit above that level to avoid getting caught in a little stop raid, because they love to do that. So there's your update on XLF. Nothing's changed. In fact, things have changed the last week. We got the breakdown. So now the financials, and by the way, guys, look what I did for you today. Well, I did it for myself, but you guys too. I updated the holdings. Remember I told you I always monitor the sectors of the S&P 500, because I say an index or a sector is simply the sum of its parts. Or in the case of the NASDAQ 100 or the S&P 500, a market cap weighted sum of its parts would be a more accurate description. But with that being said, the S&P 500 consists of 11 sectors. Tech always, and for recent years, and it wasn't always this way, but in modern history in recent years, and even tech, it's been the biggest weighting, because these high growth tech stocks, you only have a handful of $3 trillion companies in the world, and they're all tech companies. Berkshire tried to enter that realm recently, but got smacked down. I think it was Berkshire. Either way, you have XLK, tech sector, and I updated these for you. It was 25%, so forever and a day I've been telling you it's a quarter of the S&P 500. Now it's 32.44. That's through SPY's website, the SPY, the tracking ETF. And that's what we're trading, SPY. If you are trading one, you're not trading the SPX directly. You could be trading futures, which are a derivative, price not exactly what it's. So SPY, either way, they're going to be the same. They're going to be within, it's always the same. They track the index. So what my point is, we went from a quarter weighting in the S&P 500. Again, not out of 4 sectors, out of 11. One sector used to make up a fourth of the returns. Now it makes up 1/3 of the returns. And it just shows you that if and when tech breaks down, and we still have it, I still have it above this primary uptrend line. That's the last time we covered reverse. That is a massive level. I believe I have alerts set. I always do this in the videos. You can never have too many alerts. 192. If 192 goes, you take out the recent lows. You're well below the 200-day moving averages, and you're below the primary uptrend line, which is where we covered in reverse shorts last time. So big level there. And if we do this, is it going to change the technical posture? No. It'll probably increase the odds we pop up. And, this market has a history of making marginal new highs and then big corrections follow. So I just want to point that out. Now, we haven't done that yet. So unless proven otherwise, I'm treating this divergent high and bearish engulfing candle, and then followed by the wedge breakdown as the top. And as I like to say, the charts are dynamic, and so is my analysis. So if we'd start to go up there and do something different, then yeah, you're going to see this 3 months from now. You're going to see divergent. And then if we go up there and then the indicators do this and they take out the divergence, we no longer have it, then it's going to be more difficult to maintain, or make a strong bearish case, at least at that point in time. But that's not the case. Right now we have some pretty decent not just sell signal, and they played out for a correction, but they also have the potential to be, endpoint reversals based on the nature, of a bearish engulfing candle and all that. So that's it. Anyway, let's go through the rest a little quicker. So those are the levels to watch. And again, the odds will go up from whatever you want to put them at now. Let's just say you want to say that there's a 50% or 60% chance we're going to go down and hit those bear market targets I gave you of, about a 45+% drop in the NASDAQ 100 this in the coming year or so, then those odds are going to shoot up to probably, in my opinion, 70% if this level's taken out, 192. All right, so let me show you the others because they do matter. So although I just showed you that 1/3 comes from tech, so yes, we will watch big tech closely. I watch it closely, I always have, always will. Now, it was healthcare. Now the financials have piggybacked it to be the biggest sector, 12.42, 12.5% weighting. So still substantial, again, out of 11 sectors. And second largest. And I've already covered this quite a bit lately. That was, the first, that was a target we just hit. It's also the BOD support on the daily chart, meaning benefit of the doubt, big divergent high, clear sell signal. And so far we're trading right on that support level. So we just need to go down. Remember, that's yesterday's low right here, which was also the my second price target on the 60-minute chart. 60-minute just kind of I honed down on more specifically on the levels. And that's it. So that's still the deeper targets down here. Next stop on the daily is this uptrend line 42.43, then 40.66. And the 200 days. And so if we get down there, that's going to take the second largest sector in the S&P 500 down. And again, more importantly, it's the financials. It's not the, utilities or, some obscure sector that doesn't make a difference. The banking sector has problems, or the financial sector as a whole, then the market's going to have problems. And that's it. So I still like the trade, and whether you want to trade the financials, short them directly or not, you should watch them because they certainly will have an impact on the stock market, in my opinion. And then the former second, but now third largest sector right behind it is XLV, healthcare. And that is also, it's close, 11.73. So they're both about 12% weighting. So again, collectively, the two large, the second and third, healthcare and financials, make up over 22%, or almost a quarter right there. So you have, again, a third in tech and about a quarter in the next two, healthcare and the financial sector. Healthcare broke down. Obviously, they didn't like the debate the other night. Just about everybody agrees, and I think even if you're a Trump fan, you're going to agree it was she took the better of him in that one. And of course, she, healthcare for everybody. We all know. Again, I'm not going to get into too much politics here. I don't want to start, but we all know. She's going to promote a socialist agenda, and that is not good for things like the healthcare system. Okay, again, you can debate what you want, but it was, widely construed, and it still is that if she wins the election, and obviously she, leaped up in the polls after the debate, then that's not going to be good for the healthcare sector. So, again, first and foremost comes charts. I don't care about a debate. I don't care about even if she's elected. Charts speak. And they're going to price in all known variables, things that you and I don't know about. That's where we, the laymen, can get kind of some insight that insiders, the whole Nancy Pelosi's of the world and all that have always, done great trading the market because Congress is immune from insider trading rules. And of course, have the most insight to all the big things. But the charts can tell us what to do. So as of now, all I can tell you is we broke down. And we're on a sell signal there. And after a big divergent high, it looks like this is just the start. Okay, so not trying to be redundant or repetitive. I've covered this quite a bit, but that's the point I'm trying to make is we have, I do check boxes, and you can draw a little line. You're going to have bull versus bear. You put bull on this side, bear, and so the bearish case, which is overall where I see, based on the macro, the economic fundamentals, and the charts. And so lately I've been getting more and more checks. And the fact that we had the financials just recently break down in healthcare gives me additional check marks. Remember, tech has long since broken down. So unless they negate those bearish engulfing candles in the divergent highs and the wedge breaks, that's a check mark. And, you know, I won't be concerned unless 227 goes at least. And then, of course, they take out those highs. And we'll just see what the price action's like then. But that hasn't happened. So what has happened since is we're seeing other sectors that have been buoying the broad markets and finally breaking down. The fourth largest now is XLY. Still is. It was before 10% weighting. And kind of a messy chart, but you can see here's a line I've had here forever and a day. I created this line back in 2022. Back here. Let's see, created it back on January 18th. So exactly right here, the day before we broke down. So that was pretty timely stuff. So let me zoom in here. And I would have given you that line, and I color coded it yellow. And January 18th is right here, right there, the day before we broke down. If you can see in the video, there's a little tiny candle here. And so that was a level to me that would do the trick for XLY. The trick was done the following day, meaning we broke, and that made this whole thing there. That was all new highs in the XLY, the consumer discretionary sector. Again, this is a big sector that has Amazon, Tesla, Home Depot, Nike. Okay, so we broke down, and it wasn't just a run-of-the-mills. To many it probably was, but to me it was a major level. It triggered impulsive selling. They came back, tried to get back above there, rejected. Look at that, perfect rejection right there. And another smackdown, even worse. So, you know, if you missed the breakdown initially, they gave you another shot. If you missed it again, you had one last shot. And if you took that shot at 192.27, before all is said and done, you made, let me measure it for you, to the lows, you made 35% shorting. Or if you're a bull and you don't short, it's anti-American, or you don't know how, you sidestepped giving away 1/3 of your position if you were in this ETF. And again, these are the guys that move the market, Amazon, Tesla. And so where am I going? Well, we tried it again. And even the only thing more bearish than getting a rejection there is a false breakout. We had one day, you can see a single candle that printed above there. And they couldn't hold it the next day. That was a false breakdown. That was followed by a 14% swift move down. And so all I can tell you is what I was telling you 2 years ago. That's an important support level. And I'm telling you it is still. And we're coming up to that now. So we have the market at resistance. Now they can break it. And if it's anything more than just a false whipsaw, false temporary breakout that fails, then that's going to be bullish for the reasons I just showed you. That's a very significant resistance level. But Trading 101 says you do one of two things when a stock rallies up to resistance. If you are bullish, you sit tight, wait for a breakout, and then buy the breakout above resistance and go long. If you are bearish, you short the rally into resistance. Or if you already have a long position, you sell the longs. So obviously, that's the case I made today. A lot of stuff running into resistance, including but not limited to the stock indices. And all right, that's it. Oh, and then look, yeah, see these lines here? If it breaks out, my prediction, it'll be a failed breakout. It might not be a one-day wonder, but you can see anytime soon. Again, anytime soon means if you consolidate for a while, do this, and break out 6 months, a year from now, this is all going to look different. If it breaks out anytime soon, it's guaranteed to be a divergent high, simply extending these previous divergences, setting the stage for a failed breakout. But as of now, we haven't even broken out yet. We're below it, and so that's it. So like I said, objective to short. And so I'm just going through, I'm not going to go through all the sectors, but I did want to let you know, again, I updated the weightings. XLC communications, you have companies like Meta, Alphabet, Verizon, T-Mobile, there and there. And it's just a mirror image of 2022. Nobody wanted to short except me and maybe a few others back then because of this big divergent high, clean uptrend line, sell signal. Everybody wanted to buy here. And then that was followed by a drop from the highs. Roughly, we dropped about 50%. So you lost half your money in stocks like Amazon, Alphabet. This whole sector dropped 50%. Anything's possible, guys, but it's an identical technical posture. It's almost too similar. That kind of worries me a little bit sometimes when things are so obvious. But I learned at times sometimes you can overthink things and just take something for what it is. So there's your uptrend line off the lows. Let me thicken it up here so you can see it real clear. There's the uptrend line. These are your lows. Come in here, and that's it. We just need to break down below there, and it should be just like this one back here. That was purple back at the time. So it was an important level. And so, boom, broke down. And look how we did it back then too. And this is what the market tends to do. Actually, we had a sell signal, so you got in. If you didn't get in that day, see that red candle? It gave you an opportunity. And then if you missed it and you second guessed it or whatever, the next day we gapped down. And then most people wouldn't want to chase that gap down. And gaps tend to do that. So these are the best type of breakdowns. Either a gap down to cause a breakdown or a little breakdown that everyone's the bulls second guess because you're right off all-time highs. And then you gap down. What it does, it denies longs an opportunity, an easy out, because it probably bypassed a lot of their stops that they set right below there. They say, okay, we broke down, but I'll set a stop just below that low. And then, you never got out. That stop never got filled because you stayed below it and then had that 50% drop. All right, let me just shift over. That's the market. And again, let's not overthink it. You got the levels I showed you to watch. You've got the Fed coming up Wednesday. You still have giddiness that we're going to get a rate cut. And I don't mean to offend anyone, but there's just a lot of dumb money out there, including the pros, that have there's a lot of pimple-faced kids just out of college, with their MBAs and working on these, in Wall Street. And no offense if you're young, I'm just kind of telling you what's there, that they don't really pay attention to the macros. I mean, I guess we all see what we want to see. If you want to say, Randy, sit here and do an hour video, make a bullish case fundamentally for the market or technically, I can do it anytime. It's easy to make one case or another, but I'm just going to show you the things that I'm watching right now. We're going to go over to, let's start with the housing market. And so what I'm going to do here is roll into some fundamental indicators, talk about where we probably are in the bigger picture thing. I'm from Miami originally, born and raised, so I'm going to start there. I don't live there anymore. I still have a lot of family. I go there a lot. And I pick it because it's been it's widely known as one of, if not the hottest housing markets in the past several years. After COVID, everybody wanted to move to Florida and Texas, were the two big states that had the biggest inflows, both warm weather, low taxes, and everyone figured, hey, if I'm going to work at home, I might as well go somewhere where it's nice and not shovel snow in my driveway in Jersey, so and pay insane state income taxes. So they came down from those states and they came into Florida. So we're going to focus on that because you always have to look at the epicenter of the next problem. Or, when you're looking at a bubble in the tech sector, I don't want to look at XYZ. I want to look at NVIDIA because that's the poster child of the AI hype bubble, right? So when NVIDIA pops, doesn't matter. When the leader dies, the rest of them die. Same thing with the leading housing market. So what have I've been tracking this. So far, it's a blurb. This is, I'm on Redfin, by the way, looking at market trends. I look at these all the time. Prices peaked back in April and so far have been trending lower. Now there's been other peaks and you zigzag up, so you can't write this off yet. It's something that we know this from many other metrics that home prices have reached unaffordability levels, rarely if ever seen. And so based just simply on that means that at best case scenario, the housing market's going to flatten out and stay there for a while. And I know a lot have made that case. I'm not going to sit here and get into it. I'm not an expert in real estate, but I've lived through some bubbles, including Wall Street Journal named us, where I live now, Southwest Florida, at least once during the last financial crisis as ground zero. And I was intimately involved back then. I was working as a stockbroker and officer in the banks regional banks that were in the crux and the ground zero of that market. And so firsthand, I was going out talking to both customers, talking to the commercial lenders in the bank, the CEOs, and saw that firsthand. And I can tell you what happened back then. I mean, I had several branch managers quit just because they were making so much money flipping homes, in the bank branch managers. And what happened then? And everybody knew how to hand in it. Everybody but me. I just wouldn't touch that bubble. They were flipping. It was working great. It's the greater fool theory. And then all of a sudden, it didn't just crash. It took at least a good year. The housing market peaked back in '05, really, and prices flattened out. And then what you saw is days on market started going up. That's one thing I'm watching. And you saw prices, of course, flatten out. They didn't just, that's the thing about it. Sometimes the stock market, when you get a bubble, you get a blow off top and then boom, a big crash. Sometimes the topping can be slow, but in the housing market, it's usually a much slower trend. And one reason is in the stock market, everything's priced instantaneously. From 1 second to the next, to the exact penny what NVIDIA's worth. To the penny what their market cap is. Everything's done electronically. Trades happen within even a second. There's tons of trades taking places. It's not the same with the housing market. So what happens is, it takes a while for you to realize that, hey, that house down the street, man, it's been on the market for a while now. Oh, wow, they just cut the price. Boy, they were asking $2 million. Now they're only asking, they're down. They've already had 3 price cuts. So it's a slow roll. And what you want to look for is, of course, prices stagnating. Number of homes, look at the number of homes sold. I'm going back, you can only go back 5 years. You can see, and I'm also referencing, the kind of big point here is COVID. You want to look at the COVID inflection point, 2020 right here. So there's the peak, when COVID hit, everything kind of froze for a while. And so you're seeing that this is the pre-COVID numbers. Then after COVID, obviously we had that crazy bubble surge. It's caused prices to go up. So I just want you to and play around with this. Check your own market. If you live in, BFE, Idaho, doesn't move the needle for the national market, but you want to look at some major markets that are hot markets that you know about. And this is going to give you some insight. And then median days on market, you can see ticking up again in Miami. We're now at levels that we haven't seen since back here. This is when COVID hit. Again, everything stood still because we were on lockdown. And so, anyways, I want to let you know that this is a trend too, guys. You can see things peaked here. We've had these, interest rates have been going up and then falling. But this is a trend that is pretty clear to me. And that trend peaked with the trough back in 2022. And then the other metrics you can look at, of course, are sales to list price, homes sold above their asking price. This is when everybody was just a great time to be selling a home back then. Horrible time to be buying a home because everything was, never seen this. Almost 30% of homes in Miami selling above their asking price. But you can see this has come back down now to levels, and it's been coming down to these historically low levels. So that's going on now. Oh, and this one's probably one of the most important. Homes with price drops. Again, I can only go back 5 years, but you can see, and again, you don't have to be an expert chart technician to see this trend here. Homes with price drops, and we're now at levels unseen since before COVID. And again, I'm picking on Miami because it's a hot market. Houston, I've got the same thing there. You can see days of market starting to tick up, days on market. Sale price really starting to roll down now, average sale price. And homes with price drops really starting to pick up there. So anyways, I encourage you to, take a look, keep an eye on the real estate market. Now, let me show you a few others. Macrotrends.net, great site. Free charts, pretty simple to read. It's not too complex, but there's enough there. You want to check out all the different sectors if you're into precious metals. But we're going to start out here with interest rates, and we're going to start out with just one chart. I've showed it many times over, but it's very important in my opinion. Federal funds rate 62-year historical chart, right? So we're going to go back over 6 decades here, as long as this data will go, at least on this chart. And again, it's simple stuff. We know the Fed's going to cut next month. Next week. We know, or at least I predicted on August 5th on the lows, you're going to see a narrative change that's finally locked in. Because remember, they've been clamoring for a rate cut, expecting it and talking about it for well over a year now for the Fed to pivot, and yet it never came. It's now finally locked in. And it was locked in on August 5th, like I said, because of the big drop in the market. Markets were plunging, unwind of the carry trade. You had the biggest drop. You had a crash in the Japanese Nikkei index, biggest crash since the 90s, or the Black Monday went way back. And so that woke up the Fed and all the central banks. So now, as I said, let's just keep it simple. Shaded gray lines are recessions, and invariably, without exception, the Fed has rate hiking cycles. Rates either plateau or they all of a sudden from hiking they turn around and start cutting. Either way, sometimes there's a brief plateau, pause, and then the cut. And invariably, the recession comes. There's the pivot right there. That's the pivot right before the recession. There was another hiking cycle during the recession with another pivot, because remember, inflation was out of control, and then it got even more out of control here. But there was a pivot. These are recessions. It was really one long period of recessions in the late 70s into the early 80s. Pivot right there, recession. Pivot, recession. Pivot, recession. Plateaued for a while, rate hiking cycle, plateaued, pivot, recession followed. Little plateau after a rate hiking cycle, pivot, recession followed. This was COVID. It would have been a lot worse, we all know. But if you print enough money and take such extreme measures as all global central banks and global governments did, you can stave off any type of recession or market if you print enough money, any bear market. But yet it was a recession. The signal fired. And so again, this is what I'm talking about. And I don't mean to sound offensive. It's just the young generation, even folks that are making a lot of money sitting up on Wall Street. Like I said, be careful what you wish for. History shows us that with virtually no exceptions, after a rate hiking cycle, the only reason you start getting cuts is a recession at that point is inevitable. And in many cases, as some say, it's probably already here. As evidence, the Somme rule triggered recently, and some other things, the yield curve inversion. I'll get to that. I'll mention it. So we had the 210. You can see here. There's the uninversion. Remember, it's not the inversion. Same thing. Here's another indicator that with the 100% track record. Let me zoom in a little for you and grab over there. Just had to size it up. Inverted yield curve, uninversion, recession. Hopefully you can see the recessions. It's these light shaded gray box. Inversion, uninversion, recession. Inversion, uninversion, recession. Inversion, uninversion, uninverted yield curve, whatever you want to call it, recession. Inverted yield curve, uninversion, recession. Inversion, recession. Inverted, it's been a while, but we hadn't uninverted until now. Again, you can drop by. It's not, you got to go real tight. We basically just hit the line the other day. We're slightly above it, so it's technically uninverted now. So again, just like the Fed funds rate I showed you, it shows something with this has a perfect track record, and yet they're buying it, and they're buying the fact the Fed's going to cut rates when, and again, you got to be careful with the timing, because these are not timing indicators. These that I'm showing you, the Fed funds cutting rates, you can look at it if you zoom in real closely on that chart. There's some variability there to whether the recession was either underway at the time already or soon followed. And please also remember, if you're new to this, the NBER, which is the government agency that is responsible for declaring recessions, they do not have a set formula. It is a subjective measure based on what they want to say, whether we're in a recession or not. The typical old school definition is 2 quarters of negative GDP growth, contracting GDP, 2 consecutive quarters. But these are the official NBER declared recessions, and they are always, the start of the recession is always declared in hindsight. They go back, as you've seen recently, with a lot of revised data on payroll, big revisions. They do the same thing with GDP. It's revised in hindsight. Oh, hey, sorry guys, we kind of messed up, but yeah, GDP was actually down last 2 quarters, and we're going to revise it down now, and we're in a recession. And then what happens is all the fools that are buying, the rate cut, realize too late, and you get a crowded rush for the exits, because now they realize they were buying for the wrong reasons. They thought we were going to have a strong economy in 2024 and 2025. All right, a few more here, and then we'll wrap up. Let's see. I'll go back to, let me move that back a little bit. Let's go back to economy. Let's just look at a few of these, and then we'll wrap up. Which one is this? This is still loading. Okay, we'll look at housing starts. Again, I encourage you to look at these on your own. I'm not going to spend too much time. You can see, look at housing starts. Let's just look at it now. You can see it was good. We had this is COVID hit. Obviously, housing starts plunged. Government, hit the nuclear switch. Started building a lot of houses again because there was free money, zero interest rates here. Borrow it, nothing. And you had a surge, and we've clearly turned the corner. This doesn't look like an aberration to me. These are not aberrations, but the little, counter trend moves within a primary trend. This is a turn. That's a turn. That's a turn. There's a turn. You can see the recessions that followed. So there's housing starts. What do you want to look at? This is a big one to me. I've covered this quite a bit recently, without any exception. You can see all the recessions on there, and you can see that unemployment, and this is the bulls, other than the fact the S&P lately had been holding up until the financials broke. The one pillar that they've had, and they keep resting, the consensus across the board is this has been the strongest case to be long, keep buying stocks, and the strongest reason we're not going to have a recession in 2024, 2025 is the job market so strong. And as I said, every bull market and economic expansion ends with record low unemployment. And then when the hook is in, when you've clearly, as we have clearly, and look at the acceleration. I've been covering this recently. Just look at the acceleration. When you come back here, you can see it probably better. We're trending up, and it's starting to accelerate up. You can see the clear acceleration. That's not a blip anymore. These were all blips along the way. There's a turn. Happened quick when COVID hit, but here was the turn, a clear turn before the recession, a clear turn, 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 a clear turn. You get the point. Is it possible this is just an unusual blip to the upside and we're going to get this? Well, we know we're at the historic low. What's unemployment going to go to? 0? Or is it going to stay low forever? Again, look back, study this chart. Please put it in the comment section. Take a screenshot and show me any point in history where you didn't have a V bottom, where you had unemployment come down and then stay down low for an extended period of time. Again, it's always a V bottom. It's just the way it works. You can sit here. I'm not going to get into theories as to why, but it's just the natural part of the business cycle. Initial jobless claims, that's the one that came out today. It's trending up lately. It's nothing big, but that also, the thing about that one too, you go to initial jobless claims, if you look at it, that's once the recession kicks in, then it really starts going up. And anyways, that's a chart. We've had so much distortion here with COVID, but that one's there too. And it has been trending up. Didn't want to skip it. It's an important one. Retail sales, looks like they've rolled over here. This is what it's been doing. Obviously peaked here, right? Peaked here. It's been trending lower, peaked here, and that's what it does. This one doesn't V like the job market. It kind of slow rolls. That was COVID. COVID was a quick. You can see it kind of went down. Recession followed, and this fits very much with us heading into recession, probably being in one now. Auto and light truck sales. Obviously, you can see they peaked here. What's going on? We have this super strong economy. I know prices got high after COVID. We had a little relief, but this also is not looking good. Oh, big one here. U6 unemployment rate. So I already showed you the national employment rate. U6 here, it tells you what the difference is. U3 is the official unemployment rate. U5 includes discouraged workers and other marginally attached workers. And then U6 takes that and adds on workers who are part-time purely for economic reasons. So would you rather work one full-time job with healthcare and 401k benefits, or 2 or 3 part-time jobs to make the same amount of money with no benefits? Obviously. So that's that whole thing. Look at U6 cranking up. And if you, again, guys, that's an inflection point. This is not a blip. That's an inflection point. That's an inflection point. That's an inflection point. What followed after those inflection points with zero variability? And I say this because I turn the TV on and I hear these permabulls and I get it, but it's almost as if I know they have a vested interest for convincing the masses that the economy is going to go up forever and we're never going to have a recession again and the market's going to go up. But this evidence is overwhelming to me. And so, again, what I'm trying to do now, today, tomorrow, next week, those are the 60-minute charts. I think we've been doing a pretty good job of navigating the short-term ups and downs, stepping up, covering our NVIDIA shorts or index shorts at the right time, going long, gaming bounces, that short-term stuff. What I'm doing here, if there's any takeaway, is this doesn't affect how I'm going to be long or short QQQ, a week from now or 2 weeks from now. It does help formulate my bigger picture. For those of you that might say I'm crazy, looking for a 45+% drop in the NASDAQ 100 and NVIDIA and other companies like that. So we're almost done. Again, I don't know if there's any others. It's just, they're all saying the same thing here. Let me see if there's any other. Okay, let's look at durable goods. That's a good one to look at. Peak right there. Clear reversal in trend. There's the recession that followed. Peaked right here, right concurrent with the start of the recession. This one peaked here, took a while, and then COVID hit. But obviously, durable goods has been falling off a cliff and really dropping. Industrial production appears to have plateaued there. That one's not screaming anything, but it's still there. It's peaked. Jobless claims, I think I already covered that. And that's it. Yeah, 4-week average. This is what the Psalm rules based off, the 4-week average of moving claims, which I heard triggered recently with that ticking up below above a certain threshold. All right, I'm going to wrap it up here because I've got to get running. Oh, I do got to go. All right, market's about to close anyways. This has been Randy Finney with Right Side of the Chart. Have a great day.